I want to give a shout out to the one and only and great Ken McElroy. I think Ken McElroy is doing all of us a favor by calling his shot in public. If you haven't been watching his YouTube channel, you really should. Basically, Ken McElroy is saying no longer are pencils down. He is being very active. He's trying to buy several $100 million in real estate, obviously multifamily, Class A. And basically what he is saying is he might be a little early, but he wants to get the moves in now because he sees a dearth of construction coming, which will mean less supply. And given good rent absorption today, it's going to make rents go up in the future. So I really appreciate the chance that we get to watch a master at work. And again, it gives us all lessons to strike when everybody is fearful. We obviously talked to Jonathan Twombly, who is a big player in this space as well. So I wanted to get his thoughts on what Ken is doing now and what does it mean for the rest of us. Jonathan, how you doing, man?
I'm doing great, Michael. Good to be back after a couple of weeks away. So, yeah, listen, I think that what Ken is doing is very savvy, and so a number of thoughts I have on this. One is there is no reason to wait for the absolute bottom of the market to buy. When you feel like you've bought that stuff is trading at a discount, then it doesn't really matter that you haven't gotten like all of the discount that might be possible, because if you can't buy the deals, it doesn't really matter what they're trading at. So if you have the opportunity to buy, that makes sense. So I think him moving now, I mean, if he's able to find product to buy, then absolutely he should go for it. There's really no point in trying to time the market. And I'm assuming in particular that when he's looking to buy these assets, they're going to have to cash flow sufficiently to support whatever debt he's putting on them, which means that you can ride out whatever is coming your way. And the other thing being that if you're thinking about this long term, right? If you're thinking about this, it's often a good exercise to go through to think 10 years from now, will I be happy that I bought this property today? Right. And if you answer the question yes, then it's worth paying the price that you need to pay for it, assuming that you've structured the deal so that it can get through whatever's going to happen in 10 years, because over a 10-year time frame, stuff is going to happen, right? Yeah. Right. So you have to do it conservatively. The problem that happened with people in 2020 to 2022 was that they asked themselves the question, would I like to buy this would I like to own this property in 10 years? Yes. Will it be worth more than, in 10 years than it is now? Probably yes. But they did not structure those. But in order to buy those deals, they had to do funky debt structures that didn't allow them to survive what might come. Right. So
frankly, you're being too kind on most of the cohorts from 2020 to 2023. I think all of them did not have a 10-year time horizon. I think most of them were buying on the 2 or 3 year, let's go do 10% value add and sell it as a complete done deal. So I think they lost the story, right? Multifamily has always been a 10-year horizon. The good people like yourself, like Ken, like a few others, they're always thinking in decades, right? You guys were here before the stupid people. The stupid people did stupid things. Now stupid people are going to lose stupid money, but they should, because they forgot the decade, the time horizon, and the debt structure was horrible.
Or they never knew in the first place, right? I mean, they just bought into the narrative that A, multifamily always goes up, and B, interest rates always go down, right?
It's really funny that you bring this up. I actually sent you a direct message about one of those syndicators who got high on the hog and is getting burned like nobody's business right now. But they're actually advertising to come to my trainings. I said that to you, and I go, the balls on this guy is crazy. Yeah. So watch out who you get advice from, folks.
Yeah. I mean, listen, those particular people, not that one person that we're talking about, but many of those people of that ilk, the stuff that they teach makes perfect. They're not teaching you stupid stuff, right? The stuff that they teach is actually sensible. The problem is they don't act that way. Like what they actually do in practice and what they kind of like, rah their troops into doing is counter to what they actually teach you, right? Because they'll teach you,
yeah,
they'll,
I've seen these guys, and they're actually not trying to teach. It's a smoke screen to get people to invest in their funds because these deals are too big and you don't have the capital. But trust me, trust me.
There is a tremendous amount of that. Yeah, I'm just talking about like sort of what's in their teaching. If you actually go through their teaching materials, it'll say all the right stuff. But you're right. Probably a lot of people don't even crack the book, so it's I agree with you. But back to Ken.
Yeah, back to Ken.
So what I think he's doing makes sense. And the real issue, I guess, and maybe, if you've positioned yourself well, and I'm assuming that he must be sitting on enough cash that he can go into these deals at relatively low leverage, which is what it's going to take, really, because a lot of these. So if you're looking at, say, let's just take Texas as an example. There is a lot of multifamily that's come out of the ground where the market occupancy is low. I mean, like, you can't fight that. So a lot of these properties are having real trouble with lease up. They're not stabilized. You cannot get Fannie and Freddie debt on these assets because they're below 90% occupancy, right? And so what you have to do is go in there with bridge debt or CMBS debt. And the only way to make that make sense is to go in at pretty low leverage. So you're going to have, but I think as a calculated plan to go and buy these properties, these are the newest properties in the market. In most cases, they're 80%, 85% occupied. So you just value them on that basis. You go in with a lot of cash, right? And then you just wait for the market to do its work over the next few years as absorption just takes care of the excess supply in the market. And then once you hit stabilized occupancy of 90%, then you can turn around and refinance into better debt and so, and that is just a really smart play, but it takes the cash to do it, right? And probably takes the relationships with, lenders. I'm imagining this is not stuff that's on the market. He's buying this off market. It's distressed. It's direct from lender, or it's a lender, leaning heavily on the seller to sell. And you have to be of a certain stature to kind of get access to that stuff.
Yeah, this is what you and I talked about 6 or 9 months ago when this thing started to break. There was I think we said at the time, there's going to be a list of 10 operators, and it might be 25. It's a small and finite list that banks are going to look to take these assets over. And Ken McElroy is without question on that list. And the reason he's on this list is because he didn't go hog wild with value add in those things from 22 to 24. He, in fact, said he evaluated deals and was routinely, outbid by $50 million. From people doing, bad, funky debt structures. Also, Ken's been in the game a while. He has a great balance sheet at over 10,000 units. But I think you're bringing up a very interesting point. Why Ken McElroy? The title of this is going to be "Why Ken McElroy is the GOAT," and it's because he knows he's in a unique position, right? He just bought a property within 10 miles of my house in Las Vegas that was exactly like you discussed. It was brand new construction. It was in the loan was still a construction loan, and the person was dying, right? So the bank leaned on him. Ken has taken it over, and he knows he's going to have a year and a half of lease up, but then he'll get new debt and he'll be off. And running. And he not only does he have access to capital, but he also has operations. Right. That's also what I think makes Ken unique. Is I forget what he said. I think he got 1,000 employees or some crazy ass number. Yeah. So he can place people on site, to kind of like get this thing going faster.
And the thing is, like, Ken has been around for a long time, right? So so since at least like the early 1990s, maybe even the 80s, right? Yeah. He's been doing this. And it's funny. I remember I read when I first got started, maybe even before I started, I read one of his earlier books, and it was all about, it was basically like about, he was talking about buying like triplexes in the Midwest, right? It wasn't like buying big multifamily properties. It was like, I remember very distinctly, it's like, yeah, you can buy a triplex in Ohio for a 15 cap, right? And that's what you should be doing, not investing in coastal cities where you have to put 40% down to make a cash flow, right? So so clearly he has grown a lot, but he's also been around for a long time, which means that he's been through, he saw the SNL debacle.
Yes.
He saw the GFC. So he's been through this a couple of times, and now he can read the future about how this plays out, right? Because it is cyclical, and it kind of fits the pattern each time. Yeah. So maybe for people, listen, if you're sitting on cash right now, you can do the same thing on a smaller scale, but maybe you can't. But here's the thing, so I would say if you are 25 or 30 years old right now and you're just getting started, I think you should understand that this will happen again in your lifetime, right?
Correct.
This is going to happen every 10 to 15 years, right? And you can start planning ahead, right? Just know that it's going to happen. So be, just judiciously accumulating real estate. Now we're at the bottom of the cycle. Get started now. Just build. But then when you see things getting like really, really overheated, and you'll recognize the signs, because when people start saying, multifamily
real estate never goes down.
It never goes down. Rents never go down. When they start saying this time is different, they start giving you all kinds of complicated reasons why why there can never be a correction. Then you know that a correction is probably within a couple of years away. You can start stockpiling cash. So this will happen in your lifetime, and plan ahead.
Absolutely. The other thing I think that puts Ken and a few others in a very unique situation is, again, they're known entities. They have cash and have a proven track record of raising LP money. When you step back and you look at the other operators, I think there's other things going on in the bond market and with LPs, right? Limited partners. And I think right now, I think LPs were already gun shy coming into 2025. I think they are going to be even more gun shy now, especially with the stock market down 20%, up, down, up, down. I could not imagine trying to raise LP money certainly from brand new people. I couldn't imagine, trying to be a capital raiser in today's environment. Everybody's got to be scared, I would think. What are you seeing?
Well, it is definitely a lot harder to raise money now than it was a couple of years ago, without a doubt. I mean, it's been that way for a while because a lot of LPs got burned when interest rates went up because they were in deals with variable rate debt that, everybody should have known was going to go up, but nobody saw it coming. So there are a lot of people who are gun shy. That being said, a lot of those LPs, are continuing to accumulate savings because they have high earning jobs. And if they're sophisticated, they're still looking for the next opportunity. I think maybe with a little bit more experience and caution than they did before. I do think though, that when you talk about new LPs may be a better bet for you if you're trying to raise capital, because if they have not been burned in the last cycle, they're not really as focused on when I talk to people all the time about real estate, just casually, because I'm out there, whatever it is, going to the dog run, talking to other people there, whatever. And unlike you and me and people who are watching this channel who are kind of obsessed with real estate all the time, when I talk to people who are not in the real estate business about what I do, their general reaction is like, oh, that's really cool. And they have no idea that, what they'll say to me, like, oh, you must be doing really well right now. When I tell them like, oh, well, actually the commercial real estate market's been kind of like depression for the last 3 years. They're like, really? I had no idea. So if they haven't been involved with it, they're not touched by it, then they're not sort of burned. Right. And I think that they're still
it could be.
that they may be open-minded if you have a compelling deal to show them. So because one thing about real estate is that it never really loses its appeal, right? Like it's one of those assets that everybody at least feels they understand, and it's familiar to everybody. Everybody knows you can make money with real estate. The television is like bathing in shows about like flipping houses and stuff like that. So I think like your average person considers real estate and like investment property to be an aspiration. And so unless they've been directly burned by something, then I don't think that perception has changed. And I think probably the LPs that have been burned, they're probably more angry about like syndicators than they are about like about real estate per se.
Yeah.
Right. So yeah. So they may never do a syndication again, but they probably will still be interested in investing in real estate.
Okay. All right. Well, the other thing that I still think is going on is it still appears to me that Class A, right, the stuff that Ken McElroy will be evaluating, is starting to retrade at 20, 25% off. Nothing changed there. But have you seen any kind of hope that Class B and Class C will start to retrade in greater numbers? Because that market still feels frozen, still feels like price discovery hasn't happened. Is that glacial unfreezing happening?
Not yet, as far as I can tell. It seems to be that we're still, it's funny, like when you have a downturn like this, people often sell the best quality stuff they have because that's all they can sell.
That's
right?
true. Yeah.
And so, right now, I think everybody feels like they understand the value proposition of a high vacancy Class A property in a fast growing market, right? Because they can see the future here, right? They know that permits are down,
predictable,
starts are down. They know that like go after, when is it, like 2026, there's like hardly any permits. So they can see that this is going to work its way out. And all you have to do is basically buy property structured correctly so that you can survive till then, and then you're in a good spot. So I think that's what everybody is focused on right now. They're focused on buying those higher quality properties that are just currently operationally challenged, but they know that that's temporary.
Right.
That stuff has to trade before people start going to the quote unquote lower quality properties.
Yeah.
And so I think there's still a ways to go for that kind of thing.
Yeah, I still think we have likely quarters to go. This can't go on forever. The one thing that I was watching last week, and it obviously flipped this week, was interest rates. The 10-year note, got down to a low of 3.9 and was on a trajectory that some people were saying would hit towards 3.5. And what I was thinking, I was like, God, I got to talk to Jonathan, because if these rates keep going lower and we start getting, 5 handles and 4 handles on mortgages, I'm like, could that possibly save a lot of this extended pretend? They just do another year and hope it gets better, or are these things so gone that it doesn't really matter?
Yeah, I mean, the problem with a lot of, so like on the margins, yes, right, it will definitely help some properties get over the hump to refinance, without a doubt. The real question is like the degree to which that will happen, like as a percentage of the market. And I think that, properties were trading at such high valuations on such low interest rates that without getting interest rates back to near those same levels again, you just don't, it's just not possible to refinance and get your equity out. I think, the lower the interest rates get, I mean, the more likely it is that you can get some of your equity back out, right? You can cover the debt. People take a haircut, that they're willing to lick their wounds and kind of walk away. And you can do it without foreclosures, and maybe a lot of deals will be saved from foreclosure by lower interest rates. But
that's what I think happens, because again, a lot of these deals, B and C, even at the peak, we're probably going in with at least 30% LTV, probably 35,
You mean,
right? Which equity,
sorry,
with
equity,
with the
yeah, yeah,
equity side, right? So
yeah,
the loan was 65 or 70. And I think that's the stuff that gets eaten up. That equity is not whole, but maybe there's some there. But here's the problem with Class B and Class C, because again, I have experience in this market. These operators are struggling.
yeah.
They're likely not meeting debt coverage ratios. They might
Oh,
even
yeah,
be just
definitely not.
straight up. Yeah, they might even be
Yeah,
negative cash flow.
yeah,
So what happens in these buildings is they start cutting out everything,
yeah,
maintenance and all of that. So I think personally, even if we went back to rates, let's just say for a minute rates were 3%. I think a lot of these Class B and Class C buildings can't be refinanced because the quality. Because
yeah,
again, the longer this goes on, the more band-aids and crap that you ignore, and it just gets ugly. I mean, again, I tell you that building all the time that was 1.44 we got for 700 because the building wasn't maintained for a year and a half.
yeah,
It just
yeah,
gets ugly fast.
yeah. That is definitely a concern for these properties. That they just cannot afford to do anything but the most critical maintenance.
Or they'll
So,
just shut units down. Like, oh, we can't update that one. They'll just lock it up. Nobody's
oh
staying.
yeah, yeah. No, I mean, well, the thing that you would try to do is you try to rent it in its current state, right? You clean it up and
Mhm.
you try to rent it, but but you're not going to do upgrades, and you're not going to do. You're really just going to be triaging everything, right? So
Yeah.
if a pipe bursts, you fix it, but you're not going to do any preventative maintenance of any
Yeah.
kind. You're not going to you know, you're not going to paint those hallways that really need to be painted to get
Yeah.
higher rents because it's just not going to want to spend the money. So you'll just let them continue to kind of look like crap. You're not going to spend money on landscaping. You're just going to do the bare minimum. Right. So it's all those things that sort of slowly add up to, and you'll do the cheapest fixes you can too. Right. So you won't
Yep.
necessarily do like the real fix that you need. You'll do the Band-Aid fix that just buys you another year. Right.
Yep.
And that's what happens for these properties to deteriorate, which again, then you kind of just circle back where we were. These Class A properties are brand new, right?
Yep.
There's
Exactly.
there's that, and it's funny thing too about Class A. I think people should understand. Actually, I get Ken McElroy is buying brand new properties from the builders, and that play makes sense, right? Ken is also smart enough to know that brand new properties have a lot of stuff that breaks, right? Like, so the really kind of best property to buy is one that's about 3 years old,
Yeah.
because
It's been put through its paces. Yep.
yeah, it's all the stuff that's going to break after construction has already been broken and fixed,
Mhm.
and you don't have that headache to deal with. So, but all the systems are new, and so you have a
They've
lot of
gone through a
runway.
couple of winters. They've gone through a couple of summers.
Exactly, exactly. So if you're buying brand new construction, you have to understand that you're going to have to fix all the stuff that breaks after
Yeah.
new construction. But I'm sure Ken is, well reserved for that stuff, and the overall calculation is that these are brand new properties. I've got 10 years to go before I really even have to think about remodeling or
Mhm.
upgrading units or anything. At that point, I'll just sell it to a value add guy and make my profit. So
Yeah.
yeah.
Love that. Well, folks, at the end of the day, I think Ken McElroy's a goat. He's truly doing us a favor by documenting on YouTube. I kind of think of it like, Jeff Bezos and Amazon in the early days. It'd be fun to watch him go through, working out of that little office, selling books to what he is today. I think Ken McElroy's giving us a front row seat to how he adds thousands of units and hundreds of millions of dollars. Definitely subscribe to his channel. I'm watching it all the time. But Jonathan, we are doing some big things as well. I know you're looking at deals all the time. Where can people find you?
Yeah, so LinkedIn is the best place. Connect with me. I'm there every day, commenting, posting, and love to connect with you directly there.
Awesome. Thank you so much. Talk
Thank
next
you.
week. Bye.
Absolutely.